I think as fixed income investors, we are investing in balance sheets, getting paid for credit risk, convexity, complexity, and illiquidity. Right now, I think credit risk is too undervalued. Right now in the market, we saw that with the big deal yesterday of $25 billion that needed a big concession. We're finding a lot of value there.
Yesterday. Talk to us about that Amazon deal. How did that go yesterday?
Big surprise came out. We were thinking that they were almost done for the CapEx build out for this year in terms of debt issuance from the IG market. Surprised us with a big deal there, 25 basis points. Significant pushback in the market, meaning 20 to 25 basis points wider on spread. So I'm just going to translate that in. If you take a 30-year bond in Amazon, bought it 2 days before, and then the new issue comes in, you are 3.5 to 4 points down on that day.
Wow.
That's the concession the bond market built. And then you had a 1.5 times book subscription, which is much lower than if you look at the other investment grade deals.
So why is that? Is it just your market, the investment grade market, has had enough high technology paper at the moment, or is it something about Amazon per se?
It's supply overall, not Amazon. So if you break it down, fixed income investors,
ton of
again,
money sitting in your back pocket. You guys can step
yield-based money is quite a bit sitting. So that's where we bought quite a bit of that, where yield-based buyers, pensions, insurance, who have a liability, the long end bond was 6.10 to 6.15 yield on a AA type balance sheet that you can have. Yes, they have supply pressures, but fundamentals are extremely strong on the company.
Can I ask a completely?
See, he was buying the bonds yesterday.
He's like,
I don't know.
He gets 2 phone calls.
Yeah, exactly.
Vishal, if this is a compliance issue, please speak up. I don't want to get you in trouble. Price down, yield up. I looked at the Japanese 10-year today. It's on the other side of the world, as Patrick O'Brien would say, the far side of the world. We don't care, except we care. I'm looking at the SpaceX 30-year piece, and if you can't talk about this, interrupt me. The yield's gone from a published 665 to we're enjoying a 7.1% yield today. We're down 5% on that piece. Do you get concern here that selected pieces are priced down, yield up?
Actually, this is very normal for the bond market. You give us uncertainty and we want to get paid for it. And the longer term 30, 40-year bonds in any space, whether it's treasuries or any of these tech AI hyperscalers, if you will, need a lot more uncertainty, need to be priced. So if a CapEx in a company is going from 0 to 250 billion and the first issuance is 25 billion, we know there's another 200 coming behind this. And the company is in significant CapEx mode. So as debt holders, we're going to ask for more compensation.
And the difference here, I would say, Pim Fox was brilliant at this years ago. Pim Fox walked around with the Standard & Poor's 500 Blue Book. Okay, retail and institutional are different in that if I have a SpaceX 30-year, I'm in an institution, I'm in it forever, right?
Absolutely.
Where retail is like, OMG, I've gone 99 to 94, I'm in a lost position. What should they do?
I think bonds overall, yields are so powerful. Again, at the start of the segment, we talked about the 2-year providing you the cushion for negative returns. So demand more from your bond investors today in your bond funds. And I think the sweet spot for us in terms of taking credit risk in these type of hyperscalers is still that 0 to sort of 7-10-year part.
You're solving the problem. This is critical, folks. Fibonacci 101. You're solving the problem by the duration call.
That's spot on. I think go back to your bond basics, and that's where it starts to become extremely powerful at these levels of yields.
For these technology deals, these AI deals, who buys the long end of these deals? I mean, you're not buying them, are you? Hedge funds aren't buying those, are you?
I think yield-based buyers, and we do have accounts that are focused on yield. Okay. So, for example, I think if tech was giving you 5.5% at AA balance sheet and now is giving you 6.15, and you have liabilities on the other side that are at about 5.5 to 5.75, these are pretty fantastic balance sheets.
Okay.
But the key point there is you're going to buy and maintain these. You have a liability which is 10 to 15 year long, and that's where you're matching these with pretty attractive yields. So that's where it becomes pretty powerful.